Throughout this course, we have been continually mentioning that financial information being presented from our accounting system is being used by end users to make good decisions. Therefore, we need to have in place a series of internal controls to protect the end user who uses our information from potential fraud. Fraud is known as a dishonest act by an employee that results in personal benefit to the employee at the cost of the employer. This definition can be expanded to include any intentional act done by an individual with the intent to take advantage of another individual or group of individuals. Many studies have taken place regarding fraud, and common definitions include three contributing factors. We call this the fraud triangle. The fraud triangle consists of opportunity, rationalization, and financial pressure. Most studies have defined that a fraudster normally has some sort of financial pressure that causes them to consider to commit fraud. This financial pressure could be anything from living a high lifestyle, needing additional financial resources, but they feel some pressure that they need to do something to get them out of a bad situation. These employees who have had financial pressure have also been given a level of trust from their employers, which is an opportunity so that they could commit the fraud. When they do commit the fraud, they do this in an umbrella of rationalization. What we mean by that is that they believe that it's okay to commit the fraud, that the employer owes them something, they're being underpaid, or for whatever reason that committing fraud is okay. Or they may have said something to the effect that it's only temporary and that they intend to pay the company back. While there have been a historical list of financial scandals over the years, in the late 1990s and early 2000s, there were a series of financial scandals that rocked the United States. The difference with these scandals were that the fraud was perpetuated by management. Management was put under pressure for various reasons to misstate the financial statements, which affected the decision-making capabilities of the stakeholders. So in 2002, Congress passed the Sarbanes-Oxley Act of 2002. While this act primarily was focused on publicly traded companies, many of the positions of the legislation also applied to private businesses as well. While most people agreed that internal controls were important, it wasn't until the Sarbanes-Oxley Act occurred that corporate executives and the board of directors were going to be held responsible that the internal controls were in place and they were being effectively used within the organization. Also, the Sarbanes-Oxley Act noted that in many cases the independent outside auditor was not independent. They were providing other services that would impair their independence, and therefore the Sarbanes-Oxley Act specifically identified other services the auditors could not do for their clients so that they could ensure that they were independent auditors to attest to the accuracy of the financial statements. One of the biggest items in the Sarbanes-Oxley Act in creation of government entities was that Sarbanes-Oxley created the PCAOB. The PCAOB was the rule-making body that makes the generally accepted accounting principle rules for publicly traded companies. Now, when we talk about internal controls, what we're talking about are policies, procedures, methods, and measures to perform these four items. 1. Safeguard the assets of the company. 2. Enhance the accuracy and the reliability of the accounting records. 3. Increase the efficiency of the operations. and 4, ensure compliance with laws and regulations. I think when we look at all 4 of these items, all 4 are important to the operations of a company. We normally can break down internal control into 5 primary components. The first is the control environment. When we talk about the control environment, we are looking at how the company does business and how important does it place internal controls in the prevention of fraud. You might ask the question, what's management style? Does management strictly review the organizational procedures to ensure that fraud never exists? Or do they take their policies and procedures lightly where they believe that fraud never occurs and that it's not important to them? So the control environment will set the tone for everybody to determine whether there's a possibility that fraud could occur. The second component to internal control is that management, the auditors, and other employees need to take a look at the company's day-to-day operations to determine what's the likelihood or risk that fraud could occur. If there is an opportunity for fraud, we need to determine what steps we can take. In other words, number 3, the control activities can be taken to prevent fraud from occurring. Number 4 is information and communication. Employees and other members of a company should understand that there is no secret to the policies and procedures of an organization. The purpose of the policies and procedure is to protect the company and its assets, or to make the company more efficient by doing its internal controls. Therefore, it makes sense that everyone should know what the internal controls are and why they're being performed. The final component of internal controls is monitoring. Once we have assessed that there is a possibility of fraud, we have control activities to prevent the fraud, and we've communicated to all the employees and members of the company, the last part we have to do is make sure that the internal controls are being in place, they're being effective, and that they're being used on a regular basis. So therefore, we would want to monitor the company's operations to make sure that we are following our internal controls. The company needs to establish responsibility of who is responsible for the provision or the accomplishment of a given task. This task should also include who's responsible for access to assets of the company or who's to authorize various transactions. The key here is that everyone needs to know whose job is whose. We want to be able to segregate duties that are incompatible. In other words, who has access to the asset, who authorizes the transaction, and who keeps track of the transaction. We need to make sure that different individuals are keeping track of the various activities. We want to make sure that the responsibility of the record keeping of the asset should be separate from the physical custody of the asset as well as the authorization of the transaction. The company needs to make sure that all transactions are properly documented. Companies should use pre-numbered documents and standardized documents throughout the organization. And employees who are working with these documents should be moving these documents forward through the accounting system to ensure that they are properly recorded on a timely basis. We also want to make sure that the assets are protected by using physical controls. And what we mean by physical controls are actually things that you can touch and feel. We want to make sure that cash is locked up in a cash register or locked up in a safe. We want to make sure that employees are recording their time for payroll using a time clock. We want to make sure that there are inventory protection sensors on inventory items to protect from shoplifting. you can tell that there are a lot of different things we can do, and if you walk into an existing business today, you'll see that there are many physical safeguards to protect assets as part of the internal control process. Also, there should be independent internal verification. And what we mean by that is that someone should be independently verifying that the transaction is a bona fide transaction. That can be a supervisor, it can be an internal auditor, or it could be an external auditor. The key part is someone is checking that the transaction is an actual transaction and it's properly being recorded. Any discrepancies in the process should be reported to management for corrective action. Also, another type of control are human resource controls. Employees who handle cash should be bonded. The term bonding means an insurance policy on the employees to protect the company from the potential employee fraud. You also want to rotate your employees of their duties and make sure that they take a vacation. The mere note that someone else could be looking at the transaction rather than just one employee may be enough to deter fraud. Also, before hiring an employee, proper background checks should be made to ensure that there are no criminal records or any opportunities for an individual to have committed fraud in the past. Sarbanes-Oxley has now taken responsibility of making sure that management has been accountable for the protection of the assets and the efficiency of the company, in that now management needs to sign that says that they are responsible, and they take that responsibility with the possibility of penalties under the law. Now, there are limitations to any internal control system. First of all, we only want to control what we want to protect. You may have heard the term cost benefit. We want to make sure that if we're placing control, that the costs do not exceed the benefits of the protection of the asset. And even if we do have good internal controls in place, they can always be subverted by the human element. Even though we have separation of duties as an internal control, if two or more individuals work together to go around an internal control, that collusion will make the internal control ineffective. Also, if you have a small business, many times small businesses do not have the resources to maintain a very strong level of internal controls. We have to find other ways to help control the business to ensure that the company is well protected.